Howdy, Jacob here. Today we're looking at Philip Morris International, ticker symbol PM. We are in the tobacco industry, operates as a tobacco company working to deliver a smoke-free future and evolving portfolio for long term to include products outside of tobacco and nicotine. They're the primary, sell their primary products of Zins. You ever heard of them? Incorporated in 1987. Wow, that's actually way later than I thought it was. Okay, so $148.4 billion market cap, $188.3 billion enterprise value, a little bit of net debt on that balance sheet. The yield is 5.5. So not as high as the British American Tobacco or Altria that we looked at, but still a pretty very solid yield. Growth doesn't look like there's much. We see 31.2 billion in 2013 up to 31.7 billion in 2022. So relatively flat. Looks like we actually see a bit decrease till 2016 and then small increases until 2022. Return on invested capital looks absolutely astounding. We're looking at an average of probably low 30% return on invested capital, which would mean if they find something to invest in, then they could easily get 30%. Not easily, but historically they've gotten a 30% return on that money. So a lot of return on reinvestments if they were to decide to, if they have something to actually invest in. The balance sheet shows pretty much double long-term debt from 10 years ago. We have 17.6 billion in 2012 to 34.9 billion in 2022. Cash on hand is about 3.2 billion. So good amount of debt. Let's see what their cash flow is. All right, I think we can say a 5-year average is maybe 9 billion, and they pay out 7.9 billion in dividends. They had one huge acquisition in 2022. Otherwise, they don't average too large of investments in acquisitions. Their common stock, they don't buy back a whole lot of or they bought back a little bit in 2021, 2022, but then really nothing until 2015. They go from issuing debt to buying down debt. I don't like that most recent rolling 12. I wonder if that includes this 14.1. It says 17.9 billion. So that would boost up their balance sheet. I mean, in relation to earnings or in relation to cash flow, we said about 9 billion on a 5-year average basis. That's less than 4 years. Their long-term debt. They don't have a whole lot of cash on hand, so it looks like if they do find a big investment, they do go in debt to fund that. And the payout ratio is probably in the 80%, 80 to 90%. So very large payout. But if we do look at their cash flow, it's a pretty consistent business. To me, I think that, I mean, they can afford it, but they do use cash on acquisitions, a little bit on buybacks, and I want them to start consistently paying down some of that debt. And so, especially the business is transitioning from a tobacco products, mostly known for likely cigarettes and stuff, to a smokeless environment where um, they're even looking outside of like nicotine and tobacco. And so I think just the change of business could cause the change of business creates unknowns, which I do not like. I like businesses that are known, they have an easy seen path to growth, or where they're going to be in 5 to 10 years. And yeah, there's obviously going to be macro hurdles in the way and possibly smaller micro issues that could occur. But to me, huge changes like this are always tough to estimate. And so I think that when I start setting my assumptions here, I might do -1 on the revenue growth because I haven't looked at I haven't done an in-depth review to see exactly how much revenue is coming from nicotine products or smoking or not, but I'm assuming that in the next couple of years, they're pretty heavily going to be decline their revenues in their smoking portion, and then the increase due to acquisitions, and then partly due to their smoke free products is going to be a little bit, but not fully offset the decline in the actual smoking products. And then I have an 8P because again, this is one of those sin stocks. It's going to be a company that maybe not everybody wants to invest in, and so some companies have premiums, some have more conservativeness, and this would have more conservativeness due to the fact that there are a large group of individuals who do not feel comfortable owning a tobacco company, even though they are trying to move to smokeless right now. I'm sure. Right now, I'm sure that a lot of their revenue comes from smoking. Their margins, though, like Ultra and British Tobacco, are amazing. Will they change when they move from a smokeless or smoke to a smokeless one? We'll have to see how that turns out. So I'll be a little bit conservative here, saying 25, 28, no share changes. I actually want to drop this by 25% because then the payout of 8 billion would move to something like 6 billion, and 6 billion would still be in the 65-70% payout ratio, and with the rest of their money they could focus on making acquisitions if they make sense, buying back shares that are stupidly cheap, and then I'd hope that they start consistently buying back maybe $1 billion a year in that debt. I mean, we'll see how they do their capital allocation on the road. But for me, that's what I would want them to do, and that's what would make sense the most, looking at their balance sheet cash flow statement. So for me, right now, it doesn't look like it's very close to where I need it to be. It's saying it needs to drop 65% before you get a 15% return. Given these assumptions, yeah, I might have been conservative here, but I think with what comes with a smoking tobacco industry, with what comes out of them moving to a smokeless environment, there's just a lot of unknowns, and I want to be very conservative with my assumptions here. And so I'm just going to wait a little bit before it gets to a price that looks extremely attractive to me. So thank you, and I hope you have a great rest of your day.